Okay, so we'll talk about forwards and futures. These are, I guess I'll start off talking about what a forward is. Spend most of the time talking about what a forward contract is, and then just explain what the difference between a forward and a future is. There's not too much of a difference, so conceptually they're very similar. So this is a definition, I think this is from Wikipedia. So in finance, a forward contract, or simply a forward, which is what they're usually called, is a non-standardized contract between two parties to buy or sell an asset at a specified future time at a price agreed upon today. So this would be kind of like if two people or two companies got into an agreement. Let's say, for example, like over in Highlands, there's a ferry company that takes people to Manhattan. And they might be concerned that the price of oil might go up. So that's one of their costs in running their business. And if the price of oil went up very, very high, they'd have to raise the ticket prices so high, and the people might just say, I'll take the train, I'm not gonna take the ferry. So they could go out of business. So they might want to have an agreement with an oil company that says, I will buy oil from you over, 1 year from now, 2 years from now, 3 years from now, at a price we'll agree upon today. So if the price of oil starts going up or down in the future, they're locked in at this price. So they might want to do that. The company might want to do that to protect themselves against the price of oil going way up. And the oil company might want to do that just to guarantee that they'll have some customers in the future. Okay, so from the point of view of this forward contract, there are attributes to the contract. So we have one party, A, agrees at time zero right now to purchase from another party, B, an amount of a commodity or an asset at price K. So we typically use the letter K for a fixed price in financial world at some time in the future. Party A is said to be long and party B is said to be short. Okay, so K ends up being the delivery price or the forward price. Time is how far into the future do you want to exchange the money for the thing we're trying to buy in the future. And the spot price is the price at the present time, or spot price with a subscript I is the price at any point between the beginning and the end of the contract. So what is the payoff, or what is the gain or loss to party A? So the gain is going to end up being, now it's typically we use the letter S for stock, but it doesn't have to be stock. The stock at price T minus the agreed upon price K. So, and I think of the next slide as an example. And the payoff to B is the opposite of that. So however much money A wins or loses, B will lose or win the same amount. It ends up being a zero-sum game. So I think the next one is an example. Okay, so a lot of this stuff is easy to follow with an example and just by definition. So suppose somebody wanted to do a futures contract on a stock. This is unusual to do, but this gets the point across. Suppose IBM is currently selling for $100 a share. We say that's the spot price, the current price. And party A agrees to purchase one share of IBM from party B 1 year from today, and they both agree to do this for $120. So right now, no money has to be exchanged, you're just signing a contract. And what that means is 1 year from today, person A will purchase one share of IBM stock from person B for the price of $120, regardless of what happens over the year. If IBM goes up to $200 a share, person A will not like the fact that they have to buy it. No, they would like the fact that they have to buy it for $120. And person B would not like the fact that they have to sell it for $120. They'll wish they didn't agree to this. If the price of the stock is a lot below 120, then person B is happy and person A is not happy. So if the stock, for example, went up to, I give an example. Let's say the stock went up to $150. Person A would exercise the forward contract and buy the stock from person B for $120, and if they wanted to, they could sell it immediately in the market. We talked about the markets last class. They could sell it immediately for $120, and their profit would be $30. if person A makes $30, person B lost $30. No money is being gained or moved here, it's just money's being moved around. So party B has to go out to the market and buy the share for $150 and then sell it like they agreed to party A for $120 and therefore loses $30. Winnings always equals losings in forward contracts. So you're just alternating the risk, they're moving risk from one person to another. So then we start to talk about the payoffs of these contracts. So from the point of view of the person who is what we'll call long in the contract, that is the person who would benefit if the price went up higher than the value K. Right? Whatever the agreed upon price in the future is, if you're long on it, that means you're the person who has to buy this thing. You hope that a year from now, or whatever the time when it expires, you hope the price is higher than K. And everything above K is a profit to you. Everything below K would be a loss to you. And the other person would be the mirror image of this graph. So the payout 1 year from today, you look at what the price of the underlying asset is, look at it compared to K, and everything above K is profit to you. So this actually there should be a 0 here. So if 1 year from today the price of the underlying asset is K, nobody won or lost anything. In fact, you can call each other up and just say, let's forget this deal, right? Because, why bother going through the paperwork? But if it goes above K, that's a profit to the person who is long. And every dollar it goes up, this should have a slope of 1. It looks like the picture's a little stretched, but it should be a slope of 1. So for every dollar it goes above K is a $1 profit to the person who is long. And every dollar below K is a $1 loss to the person that's long. So the graph for the short payoff should be the mirror image of this. Like if we held a mirror up to this line, it would flip the graph over. So the payoff to the short side, which is the other person, is a graph that goes this way. The person who is short is hoping that the price 1 year from today, or when the contract expires, they're hoping that it's less than K. And for every dollar less than K, down to 0, you can't go into negative numbers, every dollar down to 0 would be profit to them. So it could go as high. Again, this is linear and it should have a slope of -1. So if it goes all the way down to 0, the profit is K. It could go off to, the price could go off to infinity, and therefore you would lose infinity minus K in the worst case scenario, if you were on the short side of this. So then there's an argument that there should be no arbitrage. So an arbitrage is a scenario, you know what, let me, before I even talk about that, suppose, let me go back to these two graphs. Suppose you were long and short on the same futures contract. What would your payout line look like? So really, it's like you're taking both of these, right? Nothing can stop you from making two investments, even if they contradict each other. What would your payout then be if you buy these two things? If you were long and short on the same value K?
0.
A straight line? At what point? What would the y-axis
On
be?
the same.
0.
Yeah.
You can't win or lose, right? So that's one thing I just wanted you to get used to, is the idea that every investment you could make has some graph to it. Some line like this, or a curve, or we'll start seeing like hockey stick shaped graphs. And there's no limit to how many you can pile on top of each other. So what we would then do is just take the graphs and add them together. So if we took this number K up here and the minus K down here, we just add them together and it meets at the, where, the value of y equals 0. and this would just keep going. We would end up having just a straight line across zero. That basically says no matter what the price of the underlying commodity is, we'd end up with zero. Right? We have two investments that really cancel each other out. So it's just one thing to be mindful of. So now the idea of an arbitrage, the definition of an arbitrage, I'll give a quick definition here, and later on I'll give a more textbook explanation. Suppose there was a payoff graph for some underlying stock where, and even if it was with a combination of investments, where the blue line was always above or equal to zero. Like, let's say, for example, we could have, as you can imagine, we could have a payoff that's like slants this way, then goes down this way, then comes over here, then might slant back up if we combined a bunch of investments together. What if our payoff was always zero or above for any combination of investments? Suppose we found 3 investments out in the world, and we said if we buy all 3 of these, my payoff will be, above zero, maybe it'll come down to zero, then go back above zero, but never go below zero. What comment could you make?
Make money.
You're guaranteed to make money. Well, I should say it this way, you're guaranteed
Or
to not lose money. You may make money, but definitely will not lose money. And then the other thing is, suppose we had a combination of investments where the payoff was always below zero. That would be, you'd be guaranteed to lose money or break even. You couldn't possibly win money. And we'll find out later that every possible investment you make, like buying stock, you can do the exact opposite. You could sell stock. If you want to borrow money, you can lend money. Every investment we could do the exact opposite of. So if we had a payoff graph that was always negative, we can just do the reverse of every investment, and then it would be always positive. So the definition of an arbitrage is where you have a scenario where you can't lose. You could win, but you can't lose. And that shouldn't really exist in the world, because that means the people who are on the other side of the bet are not doing their math correctly. A scenario like that shouldn't exist. So the no arbitrage argument for forward contracts is this. Suppose we have a spot price, the current price of some underlying commodity that the 2 people are signing a contract on is $100. And K, the value they agreed to spend in the future, is $126. And the future is 1 year from today. And currently the interest rate is 5%. Now this is something you'll see in these mathematical finance courses, but doesn't exist in the real world. But I'm saying the interest rate of 5% is, if you could put money in the bank and get 5%, or you can borrow money from the bank and they'll charge you 5%. In the real world, those 2 numbers never match. The bank will charge you 6% and only give you 4%. They don't match in the real world. But we're going to pretend for our purposes, because we might want to do the reverse. Instead of borrowing money, we might want to put money in a bank and receive interest. We're going to assume it's the same interest rate. So suppose the borrowing and savings rate, the rate the bank will give you, is both 5%. Is it possible that this could exist? That this contract could exist? That 2 people would agree to sell, like let's say 1 share of IBM stock, at a price of $126 in the future, 1 year from today. And you have 1 person willing to buy it and 1 person willing to sell it. Is it possible that this could happen? So, without seeing this, what is that? Does it seem like 1 person's doing something that's just wrong? What's the thing that they're doing wrong? Well, here's the thing. Suppose somebody decided right now, suppose in the market, so there's now going to be a market for these forwards. Just like we were talking about the markets, there's people who want to buy and people who want to sell. And eventually, based on the buyers and sellers, they'll meet at a certain price. So suppose right now you borrowed $100 at 5%. That means a year from now you owe the bank $105, whoever it is you borrowed from. Or since we've talked about bonds, you could if you were a company, you could sell a bond and then owe the person 105 a year from now, a 1 year bond. Okay, but you borrow $100 and you're gonna be charged 5%. You then buy a share of the stock and hold on to it, and then sign the short side of the contract. Then 1 year from now, you sell the stock for 126 as agreed upon in the contract. Regardless of what the current price is. The current price could be 200, the current price could be 50, it doesn't matter. You sell it for 126 like you agreed on it. Pay the bank back 105 and you make $21, no matter what. So the question is, why does the person who's doing the exact opposite of these steps, which would end up being, they would be on the long side of the agreement, why would a person sign up for that? Why would anybody agree to buy the stock for 126 a year from now?
They could think it's going up.
Because
But, well, okay. Right, they're anticipating it might go up, but wouldn't it be smarter for them
it could always go down, couldn't it?
to, I mean, yeah, it could go,
You
it could
stay
go
at
up or
you could stay
down.
at like 100 and they would make the $26 also.
If it stayed at 100,
The stock will be at most 126.
no, it can go above, it could go way up or way down. But the thing is, if somebody was to follow these steps, regardless of what happens, they'd be guaranteed to make $21. So the reverse of these steps would guarantee you would lose $21. And then, so the question is, let's see, what's the person who should not sign this contract? It's the person who is going to be forced to buy it for 126.
Wouldn't this like never happen?
Right, well, that's the argument, well,
'Cause,
it
like,
should never happen.
'cause then, like,
Somebody's
Because
making,
then everybody would do this, and then they'll just bid up the prices, and the arbitrage opportunity would not exist.
yeah, it would then start to go away. So who's the person who shouldn't exist in this market?
The
The person buying,
person that would actually buy the contract.
the person who would be on which side of the contract? The one who's,
The long side, right?
sell the stock, yeah, the
'Cause
person who
short
would
side
buy
will always
it.
make
The
out.
person who's agreeing to buy it for 126 in the future, they would be better off borrowing $100 from the bank and buying the stock, and then if it stayed anywhere below 126, they would lose less money. And if it went above 26, they, yeah, so the bottom line is it doesn't make sense for that person to exist. They could always do something better, and they're actually forcing themselves to lose money. So the bottom line is, nobody in that market analysis, nobody will agree to be on the I agree to buy for 126 side, unless you somehow entice them. Now, how would you entice them to sign the contract under these numbers today? Well, you're gonna, to be on the buying side, to be on the selling side, has a value of $21 today with this interest rate. So with that interest rate, there's a $21 value to being on one side of this contract, and obviously you're losing $21 on another side of the contract. So if you wanted to get somebody to sign that, you can ask them, they might ask you to pay you $21 1 year from today. So like, I'll agree to this contract, but you have to give me an additional $21 a year from today, in addition to this contract. Now it's an even contract. And if they wanted to ask for money today, what is $21 a year from now? What does that equal to today? You could count, you could subtract interest over 21 at 5% would be something like $20, right? Very close to $20. So you might be able to get the person to sign this contract at this price of 126, but you might have to pay them like $20 today, and then they'll sign the contract. Because they're expected to lose $21 in the future, which is equal to $20 today. Okay, so then, so just some more comments on that example. Using the previous example, party A is expected to make $21 a year from today. That would be equal to, this is kind of approximate. So now I'm subtracting interest, right? So remember when we were talking about interest, we said, if you want to know what some money is worth in the future, you multiply it by 1 plus the interest rate. And if you want to know what future money is worth today, you divide it by 1 plus the interest rate. So that's approximately, I should have made this approximately. So that's not, oh no, that would come out perfectly, right? 21 divided by 1.05 would be 20. So then so the risk neutral price of this forward contract would be $20 today. And forward contracts end up being traded on what they call the over-the-counter market. That's not regulated by a stock exchange. So that's going to be one difference between forwards and futures. Okay, so now, after the contract is signed, and generally forward contracts are signed at the present value of 0. There's no initial money exchange, but we just did the math. We could have an initial amount of money exchange if we wanted to. So suppose we had, here's another example, or actually is it the same example? Yes, similar example. Spot price of the underlying commodity is $100. The forward price is $105 in the future. So it's different, it's not 126. The interest rate is still 5%, and once again, the time is a year from now. So suppose two people agreed to this. Now this looks a little more sensible, right? The interest rate is 5, and the price they agreed to is 5% higher 1 year from today. So suppose the following day, after the two people sign this contract, the stock price, or whatever the underlying commodity is, drops from 100 to 95.23. And I use that number because it makes the math come out kind of easy to follow later on. Suppose it dropped the next day. Who was helped by that and who was hurt by that? Now obviously nothing really settles until the end of the year, but who so far is winning the game? Would it be the person who has to buy the commodity at 105 a year from now, or the person who has to sell it? The buyer has to pay 105, regardless of what the price is. So the buyer would like the price to skyrocket, because he or she gets to buy it for 105 no matter what. If it starts going down, that's good news for the seller, the seller side. So the question is, how much money in today's dollars did someone gain or lose? If you were just doing your bookkeeping, how much, if you signed this contract yesterday and then 1 day goes by and the underlying stock dropped to this number, how much money did you gain or lose that day, if you wanted to calculate from that point of view? So how would we do that? So we'd say we apply the interest of this would be 364 days of interest to the expected value of where we think this is going to be a year from now. So what would we expect this underlying stock to be 1 year from now? So it would be the current price times e to the interest rate, R. Remember the formula was present value times e to the RT was the formula for continuous interest rates. So what do we expect the value to be 1 year, not 1 year from today, 365ths of a year from today? It would be the current value times e to the interest rate times almost a whole year. And so the reason I chose this number is I wanted this to come back out to perfectly $100. So after 1 day, the person on the required to buy side took a hit because the stock price went down. It is now expected that the stock 1 year from today will be $100. That expectation is coming from the 5% interest rate. We assume stocks are going to go up 5%. If they're assumed to go up higher, then people will borrow money to buy the stock, and then that would close that arbitrage. So with the expectation is that the interest rate and the rate the stocks go up would be the same. Otherwise, people, like I said, people start borrowing money and buying stock, or doing the reverse of that, which is selling stock and then putting the money in the bank and letting time tick. So with the expectation that the stock will, at the end of the year, be at 100, it is expected that the buyer will lose $5 because they have to buy it for 105 and it's only worth 100. So after one day of the stock price dropping from 100 to 95.23, the forward contract that was just signed yesterday is giving that person an expected loss of $5 364 days from now. So in one day, we lost almost $5. Actually, to figure out what did we lose in today's dollars, we'd have to take $5 and then do e to the minus, which means that this is in the denominator, so we're dividing, we're calculating backwards, right? So that's just, have you been doing math recently enough to know that this minus sign just means that this part is dividing by 5. 5 divided by this. Okay. So we're using the minus sign when we have a future number and we're trying to figure out the present number. And we don't have the minus sign when we have the present number and we're trying to figure out the future number. So we're going to lose $5. We expect to lose $5 a year from today. So what does that mean in today's dollars? So that would be 5 times e to the, 5 divided by e to the RT. So the interest rate again is 5% and it's almost a whole year, which is $4.77. So for the bookkeeping of this, the company or the person who signed the forward contract saying, I agree to pay 105 a year from now regardless of what the price is. If after one day the stock price went to 95.23, that person lost $4.70 that day. Okay, so if you were from the point of view of your company's bookkeeping or your own bookkeeping, after one day party B gained $4.70, which means party A lost $4.70. Now consider if we had a rule to tie to this forward contract that said, now consider a rule added that the forward contract says that each day the value of the forward contract is calculated based on the market price of the underlying commodity. So that calculation we just did on the last slide, they typically call that mark to market. You're marking your books based on what the market changed during that day. And remember, this forward contract is what's called a derivative. Anything that derives its value from something that's sold in a stock exchange is called a derivative. So this thing, which started off with a value of 0 to both people, now has a value of $4.70 positive to one person, minus $4.70 to another person. If you mark your books based on what you gained and lost per day of this now derivative security, so a forward is a derivative security. So if you do this process of marking its value to the current market prices, they call that mark to market, and the person on the losing side has to pay the person on the winning side the exact amount, let's say that day. Let's say every day you calculated what the winner and the loser of the forward contract got, and then you make them pay that day. Yeah?
Isn't the forward contracts don't have mark to market?
Yeah, well, yeah, they don't. So, right, so where we are right now is we've talked about forward contracts. Now I'm saying, suppose we wanted to add a new rule. So this is like a forward contract with a new rule being added to it. And the new rule is every period of time, let's say once a day, we calculate how much money one person won from the other person, and we actually make them send the money, like electronically, at the end of the day. So at the end of the day, person A was ahead? No, A lost, right, and B won. So person A has to send $4.77 to person B at the end of the day. Something is like calculating this number and then moving the money from one account to another. So would there be an advantage or a disadvantage, or actually there's both, to adding that? What would be the, do you see an advantage or a disadvantage to adding this new rule?
Well, it's like there's margin. Right?
Well, I guess, so one side would be, these two people don't know each other. And what if the price started getting way out of hand and one person said, I can't afford, you know, by the end of the year, I know I promised I'd buy it or sell it at this price, but it's getting so big. Again, this wouldn't be one share, this would be like huge contracts. You know, this could go into millions to thousands or millions of dollars that they're signing to. So like this $4.70 might be $477,000 if they did the same thing but for 100,000 shares, not one share. But what if the prices got so, what if the underlying stock shot up so high that the guy on the losing side just doesn't have the money to pay? What would happen?
The broker would just liquidate their position.
Yeah, but if they didn't give enough collateral, there might not be enough stuff to liquidate, so you might have to be concerned you may not get paid. But so a mechanism like this, where you pay every day, at least they're making payments along the way, finally they might run out of money and say, I can't be on this side of the contract anymore. And they might go out to the market and try to sell it to somebody else, get somebody else to be on one side of the contract. So this could help in the default on the contract. If you make the person pay every day, then they'll be making little payments till they run out of money, at least you'll get some of your money back. But then the downside is this computation has to be done every day, and then banking has to be done. Money has to be taken out of one account and transferred to another. Records of how much money went back and forth would have to be generated. But do you think that's a better approach or not a better approach, or adding this additional rule? Yeah, actually I put in this comment, less likely chance that the losing side would build up a massive loss and may default on the contract. So if we added this additional rule,
There's collateral.
what's that?
There's collateral, isn't it? Collateral?
Yeah, I mean, so if you want people to, before they can be on either side of the contract, they would have to put up collateral and register the collateral in some brokerage's name, so the brokerage could sell it off if they had to. You could do that, but there's no requirement that futures contracts do that. So, I'm sorry, forward contracts. So a futures contract, there are a few differences between a futures contract and a forward contract, but and a lot of it has to do with legally, you know, it's future contracts are traded on registered exchanges like the New York Stock Exchange and the Philadelphia Stock Exchange, and the forward contracts are done over the counter. That's just people calling up people looking for, you know, hey, do you have a friend who wants to buy one? It's kind of word of mouth. So legally there's differences between forwards and futures, but the biggest difference between forwards and futures is that extra rule I'm saying, that at the end of each day you settle up how much money you gained on the mark-to-market calculation. So a futures contract is like a forward contract, except that the net present value, which is calculated using mark-to-market, is exchanged between both parties on a daily basis. And the daily payments are calculated and enforced by the brokerage between the two parties. And futures are bought and sold on registered exchanges. But other than that, conceptually, the futures and forwards are basically the same idea. So it's basically two different entities agreeing to purchase something, and it's pretty much like when you go down to the store and buy something. You go to the mall and buy a shirt, you're buying it. But the only difference is if the day you agree that the purchase happens is sometime in the future, but you're agreeing on the price today, that's considered a future. So it's a future purchase. You're just saying, I will buy this from you 3 years from now instead of buying it now. Okay, so now, like, what is the difference between this and a bond, let's say a zero coupon bond. So a zero coupon bond is a bond where I give you money today and then you give me more money in the future. One payment in the future, not a series of payments. So, like, how's this different from a bond? Well, I mean, it's different in the way it's executed, but interest rate wise, it's very similar. Right, it's just something, it's, instead of, in the bond, one person is giving up the money today to get the money in the future. And in the forwards and futures market, you're both agreeing to an exchange in the future. So no money's being given up today. Then again, futures money is exchanged on a daily basis based on that mark-to-market calculation. But a forward is basically saying that we're agreeing to a price in the future and the exchange will be done in the future. So bond is basically, one person is giving up money today and getting money in the future, and the other one is they're both actually giving up and getting money in the future, based on agreement. But they're both pinned to the current interest rates. So if you were running a company, suppose you were the CEO of a company, you could, if you needed to raise money, now, what are some things you could do? The two main things you could do is you can print more of your company's stock and start selling it. Now, would that hurt the value of your company's stock?
Yeah.
Theoretically and in reality. Theoretically, should it hurt your company's stock?
Yeah, because it dilutes your EPS.
Yeah, it's diluting your company's stock, but, so
And now they have to issue it for less than what it's selling for, right?
well, okay, so yeah, this is just kind of like an interesting side conversation. If you're running a company and your company needs to raise money, there's some new project you want to start and you need money, you need to hire some people. You have a couple of choices on how to raise money. One would be to issue bonds, saying, you're saying to the general public, give me money and I will pay back in the future with some interest. The other way is to issue more stock. So let's say a company has 1 million shares out in the public, selling for $100 each. So you have your company should be worth $100 million. So that's what's called the market cap of your company. Market capitalization of your company is the current stock price times the number of shares. So let's say you had a company that's worth $100 million, and now you printed up, what did I say, 1 million shares?
Yep.
Suppose you printed up another, I'll exaggerate it, another 1 million shares. You've doubled the amount of shares. And you sold them all into the market and got $100 each. Theoretically, should your company drop in value? Obviously, there's now twice as many shares, so each share carries half as much weight as it used to, half as much ownership as it used to. Did the value of your company go up by this transaction?
Yeah. Well,
You just collected another $100 million. Your company was worth $100 million. Now you've printed up this stock and sold it to the general public.
well, then your market cap goes up, right?
Right, theoretically, the value of your company doubled, but the number of shares also doubled, so their value should theoretically stay the same. But what happens in the real world, a lot of times if a company prints up more stock, the assumption is something's wrong, and then people start selling the stock. So theoretically, printing stock should not lower the value of your company, because all the extra money you're raising is part of your company. So the value of your company will go up by how much stock you sold, and the value of each stock will drop also by the ratio of how much you sold. So the stock price should theoretically stay the same.
Well,
And the same thing's also true when you issue bonds. you are receiving money, but now you owe money. But the amount you're receiving and the amount you're owing, except for the interest part, should be the same. So issuing bonds should theoretically not affect your company. But a lot of times when a company needs to raise money, the expectation is something's wrong and they need money. And that usually makes the stock price go down. So whenever you hear a company is, they call that floating stock, when they start printing up more shares and just selling them. When you hear a company's floating stock, a lot of times that'll cause the price to drop. And if a company starts issuing bonds, a heavy offering of bonds, the price would drop too. But another thing you could do as CEO is start signing futures contracts, which will kind of lock your company into certain prices. And that could also be considered good news or bad news, depending on the contracts you're signing. Yeah.
But when you like issue more stock, like isn't it there's like more supply coming to the market, so it
Well, yeah, that's the other thing. So when it first hits the market,
it
there's
lowers prices
right.
because it's excess of supply over the demand.
Right, so yeah, when you think about the market, like we were saying when we talked about markets, we had market orders and limit orders. And if a bunch of orders came in on one side at market, they would eat through the other side, and it would drop the prices down. But when you announce you're floating the stock, then people should think, oh, this company's value should be going up because they're raising money, so maybe I should start buying it. And theoretically, the buyers should equal the sellers. But it doesn't happen in the real world, so it's, you know, there's one thing, yeah, theoretically, how you can affect your company's price, and you have a few ways of doing it. I'm sorry, if you wanted to raise money, there's a few ways of doing it. One is printing up stock, and the other one is issuing bonds. And theoretically, both of them should not affect the stock price, but depending on how it's perceived by the public, could do it, and then you have to decide which is the better way to raise money. And then, yeah, another one would be, like, big companies sign these contracts. So these are not really contracts for just individual investors on one share of stock. I was just using that as the example, but these would be large contracts, usually between companies, forwards and futures. Okay.